If you've ever found yourself Googling best ETF, scrolling through stock advice on social media, or comparing charts without knowing what to trust, listen, you're not alone. Everyone wants the best investment, but almost no one knows what they're actually looking for. The real question isn't, what's the best ETF? It's which strategy fits the life you want 10, 20, or 30 years from now. So that's what we're going to do together. I'm going to walk you and John through 3 simple ETF portfolios. Each one is built for a different kind of future. One is for income, another is for maximum total returns, and one gives you some of both. I'll break down exactly how each portfolio works, the type of investor it serves, and the long-term outcomes you can expect. I'll show you a portfolio that pays over $10,000 in monthly dividend income. And at the end, I'll show you the exact portfolio that could turn just $10 a day into more than $3 million. Before we talk about specific portfolios, it helps to understand the world we're investing in right now. And honestly, it is a weird mix of 2 things happening at the same time. On one side, the cost of everyday life keeps creeping up. According to recent numbers from the U.S. Bureau of Labor Statistics, inflation rose about 3% over the 12 months ending September 2025, and food prices climbed a bit over 3% as well. It doesn't sound dramatic, but year after year, that rise makes it tougher for people to save, invest, and feel confident about their future. On the other side, the stock market has its own mood, and it's not always comfortable. If you look back nearly a century at the S&P 500, you'll see wild swings that make today's volatility feel almost normal. Some years shoot up, like 1933, 1995, or 2013, and some years fall hard, like 1974, 2008, or 2022. Even the 1930s, one of the roughest decades ever, mixed massive drops with recoveries. When you zoom out far enough, you notice something most investors tend to forget. The market climbs over time, but it does it while taking you through plenty of turbulence along the way. Understanding that makes the daily headlines a lot easier to deal with. Markets tend to follow the same repeating pattern: growth, excitement, pullbacks, and recovery. Once you've seen this cycle enough times, the short-term swings feel less like danger and more like part of the normal process. To navigate these cycles, think of your wealth as having 3 engines. The income engine that gives you a steady cash flow so you're not relying on selling shares during down years. The balanced engine that cushions your portfolio during corrections and drawdowns. And the growth engine that fuels long-term growth so your wealth grows faster than inflation. Everyone uses these 3 engines even if they've never thought about it this way. The 3 ETF portfolios we're about to go through are built by adjusting the strength of each engine depending on the kind of future you want. Once you see how the bigger picture works, it's easier to understand the tool that ties these engines together and makes everything far simpler than most people think when it comes to ETFs. So ETFs have become the favorite tool for everyday investors for one simple reason: they make investing way easier than people think. Instead of spending hours trying to pick the right companies or guessing which sector will take off next year, an ETF lets you buy a whole group of stocks in a single move. It's like getting instant diversification without having to build everything piece by piece. To see why this matters, imagine putting $1,000 into one tech company. If that company drops 40%, you feel the full hit and your $1,000 then becomes just $600. But if you put that same $1,000 into a tech ETF, holding 100 different companies, one of them having a rough year barely makes a dent. Maybe the ETF slips by 1% or 2, which is far easier to recover from. That's the safety that comes from spreading your risk. ETFs also help you understand where your returns are coming from. Part of it is the dividend yield, which is basically the cash your investment pays you every year. Then you have dividend growth, which shows how fast that cash is increasing over time. And finally, there's price appreciation, which is the long-term boost you get as the companies inside the ETF grow and become more valuable. Those three pieces, income, rising income, and long-term growth, work together in a way that feels simple and predictable. Another huge advantage is automation. ETFs rebalance on their own, update their holdings, and adjust as the market changes, so you don't have to constantly babysit your portfolio or worry that you're falling behind. And since ETFs are the building blocks of every portfolio we're about to look at, the next question becomes pretty simple. How do you figure out which ones are actually worth owning? In a couple of minutes, I'll show you what ETFs I chose for an income portfolio, how they turn an income portfolio into paying over $10,000 in monthly dividend income, and at the end, I'll show you the growth portfolio that could turn just $10 a day into more than $3 million. But before we get into any of that, the real question is how you even choose these ETFs in the first place. A lot of people make ETF research way more complicated than it needs to be, so it helps to use a system that cuts through all the noise. Instead of drowning in charts and scrolling through endless financial jargon, you can focus on 4 things that show almost everything important about an ETF. The first is quality. This is basically asking, are the companies inside this ETF solid? You're looking for businesses with real earnings, healthy balance sheets, and a track record of surviving both good markets and bad ones. High-quality companies give your portfolio a stronger backbone. Then there's growth, which tells you whether these companies are actually expanding. Are they bringing in more revenue? Are their profits trending upward? Are they becoming more dominant in their industries? Growth is what pushes the value of your ETF higher as the years go by. The next piece is stability. This is all about understanding how well the ETF holds up when the market gets shaky. Stability doesn't remove risk, but it does keep you from riding an emotional roller coaster every time the market dips. And staying calm during those dips is one of the biggest advantages an investor can have. Finally, there's income. This is where dividends come in, the cash the ETF pays you, and how consistently that cash grows over time. In markets that move sideways or feel uncertain, having a reliable income makes it easier to stay invested without stressing over every price swing. When you look at an ETF through those 4 lenses, quality, growth, stability, and income, it becomes much easier to tell which ones are built for the long haul and which ones don't support the future you're aiming for. And once you see the difference, the portfolios we're about to break down start to make a lot of sense. Now, beginner investors often run into the same problems, not because they lack ability, but because they rely on instinct instead of structure. One major mistake is chasing hype, buying whatever is trending without understanding the fundamentals. This usually leads to buying at high prices and selling after the excitement fades. Another frequent issue is panic selling during normal market dips. A drop of 10 or 15% feels scary, but it's a routine part of long-term investing, not a signal to exit. Lack of strategy is another challenge. Many beginners buy random ETFs or switch approaches too often, creating a portfolio without direction. There's also the problem of putting too much money into a single stock or sector known as over-concentration. Sure, it feels exciting when that one idea is doing well, but if anything goes wrong, your entire portfolio feels it. That's usually when people realize diversification isn't just a fancy word, it's real protection. And then there's the emotional side. Checking your portfolio every hour, reacting to every red candle, or trying to time every bounce almost always leads to rushed decisions. It's exhausting and usually hurts returns far more than the market ever does. New investors also tend to overlook the importance of dividends, stability, and diversification, focusing only on quick gains rather than building a resilient foundation. These mistakes add unnecessary risk and make investing more stressful than it needs to be. Recognizing these patterns early makes them easy to avoid, which is exactly why structured ETF portfolios provide such a strong, reliable starting point. So, with those mistakes out of the way, let's start with the income portfolio. This portfolio is built for one goal: steady, reliable cash flow with slow, consistent, long-term growth. It's the portfolio people choose when they want predictability, something that reduces stress instead of adding to it. This portfolio leans heavily on two things: stability and income, and it uses three ETFs that fit together surprisingly well: JEPI, SCHD, and BND. Each one brings a different strength, and together they create a foundation that handles volatility while continuing to pay you along the way. JEPI is the main income driver here. Its dividend yield sits at 8.26%, which is one of the highest among large, diversified ETFs. It follows a covered call strategy, which basically means it gives up some potential upside in exchange for steady monthly payouts. For an income-focused investor, that trade-off feels more like a feature than a drawback. And even with that defensive approach, JEPI still manages a 5.49% dividend growth rate and a 2.12% annual appreciation over time. Schwab U.S. Dividend Equity ETF, or SCHD, brings strength and durability. It focuses on companies with real earnings and solid balance sheets, businesses built to last. With a 3.8% yield, a strong 10.43% dividend growth rate, and 7.95% annual appreciation, SCHD is the long-term compounder of the portfolio. Vanguard Total Bond Market Index Fund ETF with the ticker BND completes the trio by adding stability. As a broad bond market ETF with a 3.8% dividend yield and a 3.57% dividend growth rate, BND helps smooth out market volatility. Its long-term price return sits at negative 0.85%, but that's expected for a bond fund during rising rate environments. Its purpose isn't growth, it's protection. It stabilizes the portfolio during market dips, helping you stay invested without stress. The next step is to calculate the portfolio metrics, and the easiest place to start is with the portfolio's dividend yield. Since we're using three ETFs in this income portfolio, we'll keep it very simple and use a basic average. First, we list the individual dividend yields for each ETF. JEPI has a yield of 8.26%, SCHD has a yield of 3.8%, and BND also has a yield of 3.8%. Next, we add those three numbers together. 8.26 plus 3.8 plus 3.8 gives us a total of 15.86. Then we divide that total by the number of ETFs in the portfolio, which is 3. So we take 15.86 and divide it by 3, which gives us 5.2866. When we round that to 2 decimal places, we get a portfolio dividend yield of 5.29%. That's how we arrive at the income portfolio's 5.29% dividend yield using a simple average method. You can follow this exact same process for the portfolio's dividend growth rate and its share price appreciation as well. And when you apply the same simple average method to those numbers, you get a dividend growth rate of 6.5% and an annual share price appreciation of 3.07% for this portfolio. To see how this plays out in real life, let's say John invests $10 a day in this portfolio. By the end of year 1, he would have invested $3,650 in total. After 10 years, the portfolio is expected to grow to around $57,037. After 20 years, it's projected to reach about $237,440, and after 30 years, the projection shows it climbing to roughly $1,053,078. What really stands out is what makes up that final number. Based on the projections, Around $747,615 of the total would come from reinvested dividends compounding over the years, while about $195,963 would come from long-term price appreciation. By year 30, the projected annual dividend income sits around $125,746, which works out to roughly $10,479 a month, all without selling a single share. That combination of income and stability is what makes this portfolio, the income portfolio, so appealing, especially for people who want predictable cash flow. But if you're looking for something that still feels steady while offering a bit more long-term acceleration, the next portfolio might fit you even better. The balanced portfolio is built for investors who want meaningful growth but don't want to deal with the sharp ups and downs that come with a pure growth strategy. It's stronger than a conservative income-focused setup, but it doesn't swing nearly as wildly as a tech-heavy portfolio. It combines stability, growth, and global diversification in a way that feels steady during rough markets and rewarding during strong ones. SCHD is the foundation here, too. Even though we talked about it earlier, its purpose in this portfolio is straightforward. It adds strength and reliability. SCHD helps smooth out volatility, keeps the portfolio grounded when markets get noisy, and continues to grow its dividends year after year without dragging down performance. Vanguard Information Technology Index Fund ETF, or VGT, is where the acceleration comes in. It's one of the strong technology ETFs available, capturing growth across cloud computing, semiconductors, software, artificial intelligence, cybersecurity, you name it. With a 0.4% dividend yield, a 10.11% dividend growth rate, and a 21.82% annual price appreciation, VGT is the engine that gives this portfolio its long-term push. And finally, the iShares International Equity Factor ETF, or INTF, adds a layer most investors forget about: global diversification. It offers a 2.67% yield, a strong 19.36% dividend growth rate, and a 4.79% annual appreciation. The real value here is that it doesn't rely on the U.S. market to carry everything. Different regions lead at different times, and having international exposure helps the portfolio stay resilient and balanced even when the U.S. cools off. When you combine these three ETFs, SCHD, VGT, and INTF, you end up with a portfolio that sits comfortably between safety and growth. The simple average shows a 2.29% dividend yield, a 13.3% dividend growth rate, and an 11.52% annual price appreciation. You get stability from SCHD, acceleration from VGT, and diversification from INTF, all pulling in the same direction. To see what that looks like in real life, let's say John invests $10 a day in this portfolio. By the end of the first year, he would have invested $3,650. After 10 years, the portfolio is projected to grow to around $70,821. After 20 years, it's expected to reach roughly $346,384. And after 30 years, the projections show it climbing to about $1,482,394. Around $1,054,796 of it would come from capital appreciation alone, with another $318,097 coming from reinvested dividends, doing their work year after year. By year 30, the projected annual dividend income sits around $48,973, which is roughly $4,081 per month. Compared to the income portfolio, it ends up adding roughly $429,000 more in total value. It doesn't produce as much dividend income as the income-focused setup, but the income it does produce is still meaningful, and the higher long-term growth makes up the difference in a powerful way. That is why it's called a balanced portfolio. Now let's move on to the strategy built for one purpose: The growth portfolio is built for one purpose: maximum long-term wealth creation. It leans almost entirely on the expansion engine, focusing on companies and sectors with the strongest potential for future innovation. This portfolio is designed for investors who can handle short-term volatility and temporary swings in exchange for a much larger payoff over decades. The goal here isn't a monthly payout. It's multiplying your money by owning the businesses shaping tomorrow's economy. VGT sits right at the center of this strategy. Since we already covered it, you know what it brings to the table. In this portfolio, its role is simple. It's the main growth engine. With its focus on technology and innovation, VGT is what gives this strategy its high compounding potential. Invesco's QQQ adds another layer of acceleration. It tracks a powerful mix of leaders across tech, biotech, communication, and consumer innovation. With a 0.46% yield, a 9.45% dividend growth rate, and a 17.12% annual appreciation, QQQ has built a reputation for outperforming broad market indexes for decades. It brings both quality and speed. Then there's the iShares Russell 1000 Growth ETF with the ticker IWF, which broadens the portfolio's reach. With a 0.34% yield, 2.03% dividend growth rate, and 16.45% annual appreciation, it expands growth exposure beyond pure tech by adding dominant companies in finance, healthcare, retail, industrials, and consumer services. This reduces over-concentration in technology while keeping the focus squarely on long-term growth. IWF makes the portfolio more well-rounded and resilient during periods when the tech sector cools off. Together, these three ETFs create a portfolio with an average dividend yield of 0.4%, a 7.2% dividend growth rate, and an 18.46% annual price appreciation. The low yield is intentional because this strategy isn't designed to pay you. It's focused on building the future value of your money. With its 18.46% appreciation rate leading the way, this portfolio offers the highest long-term upside of all three strategies in this video. So to understand the impact, let's say John now invests $10 a day in this growth-focused portfolio. After 10 years, the portfolio is projected to grow to about $88,720. After 20 years, it's expected to reach around $574,069. And after 30 years, the projections show it climbing to roughly $3,218,567. Now, only about $4,741 would come from dividends over that entire period, while an incredible $3,104,326 would come from capital appreciation alone. By year 30, the projected annual dividend income sits around $339, which is roughly $28 a month. It's tiny, but that's the point. The value here comes from growth, not income. And when you stack this portfolio against the other two, the difference becomes almost impossible to miss. Compared to the income portfolio, the growth portfolio ends up creating roughly $2.16 million more in total value over 30 years. And when you compare it to the balanced portfolio, it outperforms it by about $1.73 million. The trade-off, of course, is the dividend income. The growth portfolio pays almost nothing compared to the steady monthly income you get from the other two. But if your priority is maximizing long-term wealth rather than collecting checks along the way, the sheer compounding power here makes the lack of dividends a very intentional choice. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.